That's
Excellent, excellent. Well,
And I
good
will
afternoon, everyone.
mute people as they come on.
Okay, excellent, excellent. Well, good afternoon, everyone. And again, thanks so much for joining us in this ninth or 10th week of our Safe at Home strategies. We're hoping everybody is safe and healthy and everyone's doing well. This is Michelle Tisch. I am the RVP for Life Solutions. And with me today, I have Dan Hardy, who is in our Business Solutions area. He's an expert in many different solutions and an excellent resource to work with on a number of the business cases. So today our topic is business retirement planning for both C and S owners. And, someone asked me, are you getting a lot of demand or requests for this type of a solution right now? And the answer is not really a lot. Right now, business owners are pretty concerned with keeping their doors open. They may be, taking on loans or even taking money from their qualified plan as allowed under the CARES Act just to keep the business afloat. But the general thought and the consensus is that we will rebound, and hopefully soon. The business owners are then going to need a lot of help in rebuilding their retirement incomes. And hopefully what we share today will prep you to advise them when that time comes. And there really are a number of businesses that are still doing very well. And many of those owners of those businesses are more cognizant of the need to plan, whether that's risk planning or retirement planning. So our focus today is to give you some information and ideas in helping your business owners plan for retirement. Business owners really do have kind of a unique challenge. Most business owners, if you ask them, what's your retirement plan? They say, it's my business. I'm either going to sell it or I'm going to somehow give it to my kids. And they really don't have any plan for how they're going to do that. They don't have any formal planning on how they're going to monetize their business at retirement. So they need your help to make their ideas a plan and then turn that plan into reality. And before you really get into helping business owners put together a plan, you need to have a good understanding of the taxation of various types of firms and how that relates to the owner's taxation. Their goal is always to tax leverage. They want to get the most efficient and effective way to plan, and they're always wanting to pay the least amount in taxes. So understanding how all of that interplays is something we'll talk a little bit about today as well. And then finally, we will look at several plan types that are going to work for business owners. One of them is loan split dollar, but we'll take a look at some others as well. Principal definitely understands how hard it is to get business owners to do any planning. So having good tools is a key. And I think everyone on the line is very familiar with our complimentary informal business valuation. And that's a great first step in planning, because if the business is their retirement and they plan on selling it, they need to know how much that's worth. But that's really just the first step. Then you need to talk about how do you actually turn that into retirement income or monetize it? And will it be enough? So Principal has really put together a full retirement analysis that takes all of that into account. It shows them how they can monetize the business and what other resources and retirement solutions are available as well. The next slide gives you an idea of kind of just what that cover looks like as far as the actual analysis that we put together. And we'll go through some of the different components of that today and kind of show you how you can use that to help a business owner understand where they really are from a planning perspective. Dan, did you want to dig a little bit more into what the report provides?
Yeah, Michelle, you hit on one key point, and that's changing business value into retirement value. And I really like this slide. This is one of the selected pieces from the business owner retirement analysis, because it really takes into account the considerations of what the sales price of the business is and how that affects their replacement ratio from a retirement income standpoint. So in this example, a $5 million sale of the business would support that income goal of $200,000. If they fall shy of that $5 million, they're going to fall shy of that retirement income goal as well. So this just does a great job of maybe tying those two together, the business value and retirement value for business owners. A little bit more customized approach is another part of the business owner retirement analysis that we'll put together. And again, it's a tack on or an additional service that we will are happy to perform after an informal business valuation. Or if you know the value of the business, we're happy to do that and plug that into this report as well. Many of you are probably familiar with similar reports. This just lays it all, puts a bow around it and lays it all together. So it talks about the business valuation, the succession strategies, and then how that affects their retirement income plan. As we see in this slide, this specific business owner would have a substantial amount coming from the sale of their business, a decent amount coming from Social Security, other investment accounts, and please do make sure to mute your lines. I hear a couple of people maybe with some background noise, so I may have to go ahead and mute lines, but we'll charge on. So the other items that are factored in this proposal would be pension plans, qualified plans, any life insurance that may be that they have funded for supplemental retirement income needs as well. And then it clearly identifies in the bright red that shortfall that the business owner is going to have based on all of those retirement income sources. So many times I've seen advisors that use this report to say, here's where we are based on what you think the business is worth or what the informal business valuation said the business is worth. We've now implemented a succession plan for you. Here's the retirement income shortfall that we have based on all of the assumptions we have in today's world. So it aggregates, again, brokerage, non-qualified, qualified plans, and other savings accounts, and it clearly identifies that retirement income gap. A second component of this then is once we establish what type of a solution, life insurance-based solution typically, that we can implement to supplement their retirement, going back and revisiting this and hopefully having eliminated that bright red on the far right-hand side of the proposal. A few things, taking a step back, that proposal is a great tool for you, but really it's starting the conversation. We're a solutions-based company, and I know a lot of you on the line are solutions-based advisors. It all starts with a conversation of identifying the pain points. And so there are a couple of ways that we've found advisors having success in approaching that conversation or broaching that conversation. Three of them that I'll list here would be fairness for both the buyer and seller, so making sure that the buyer is going to get fair value what they're purchasing, as well as that seller is going to be receiving fair value and isn't required to be a motivated seller when they're going to be receiving less value. So that's the second one. I always like to say business owners have two ways to sell their business. They can either sell their business from a position of weakness, please take this business, or they can sell their business from a position of power. Obviously, if they're selling that from that position of power, they're going to have that opportunity to have a little bit more market value or market representative value that they're going to be receiving for the business. And then lastly, we want to make sure that we have a strategic plan in place and identify if there are any delays in that succession plan, if the one wasn't put in place. Retirement income for those business owners can be impacted because all of a sudden they thought they were going to have this influx of cash from the sale of the business, and it may be delayed or in some cases not come at all. So those are a couple of ways to broach the conversation with your business owner clients. Again, it's an incredibly important topic. Michelle laid out that about 80% of business owners say that the business is their retirement plan, no matter how you slice that. One thing that's very important as we're talking about these supplemental retirement income strategies for business owners is business owner taxation. So I want to spend a few minutes here today talking about the basics of retirement income and taxation for business owners. So this is the building blocks as you design a plan. There's very important two types of business that we'll talk about today. There are your C corporations, which many of you are familiar with, where there's two levels of taxation, both an entity taxation and a personal income taxation. The one that we see a lot is this flow-through type businesses. So these are your S corporations, as you see on the screen. These are your LLC members taxed as partnerships. These are partnerships. These are sole proprietors. Flow-through businesses, generally speaking, there's a little bit different verbiage that we use, but I'll generalize these in that these types of business owners are paid in two different ways. They're paid in W-2 income, and they're paid in a dividend or K-1 income from the business. Think of this as the profit distribution from that business. So the W-2, a couple of key items here is it is set by that owner or by the LLC members, and it must be a reasonable salary. So we see a lot of business owners that want to pay themselves $1 as an example, and obviously would want to have a conversation with their CPA to determine if that's a reasonable salary, but in my opinion, that would not be a reasonable salary. The reason they may want to set that lower or be on the lower end of that definition of a reasonable salary is that not only is this income subject to federal income tax, but it's also subject to those employment taxes. So your Social Security and Medicare tax is also going to be included on this first component of their compensation, W-2 income. The second component for LLC members and for S-Corp owners is what's called a K-1 or a dividend if you're an LLC. And with this, it's still going to be taxable from an income tax standpoint, but there's going to be no employment tax that's due on this income as well. The last key piece to look at on this is as a result of the Tax Cuts and Jobs Act of 2017, there is a special deduction that will sunset at the end of 2025 for these flow-through businesses. And many of you are aware of this. This is what's called the 199A deduction. And I will generally speak to business owners that are taking home $315,000, $320,000 or less of married filing jointly taxable income. Generally speaking, those owners, regardless of industry, are going to be receiving a 20% deduction on that K-1 distribution that they'd be receiving. So think of it this, I always give an example here is if I've got a W-2 income of $100,000 and I have profits flowing through to me of $200,000, prior to the Tax Cuts and Jobs Act, I had $300,000 of taxable income. Now I'm actually going to have that same $100,000 W-2 income, but I'm going to have a 20% deduction on that $200,000 that's flowing through to me on my K-1. So instead of $200,000, I'm only getting taxed on $160,000. So my total taxable income for federal income tax purposes is $260,000 instead of $300,000. So it's a substantial amount. Above that $315,000 or $320,000 roughly, it gets a little bit complicated because we're looking at the type of industry in which that business is going to be operating. And this is where we're talking about specified services businesses versus maybe a construction company as an example. So just wanted to make sure I touch on that, that 199A deduction. That is something that sunsets at the end of 2025. So these types of plans that we'll walk through next are especially important to discuss with your business owner clients where they are after-tax solutions. So let's talk a little bit about that after-tax solution, the S-owner bonus or the LLC member bonus. Think of this as a super Roth IRA. Many of you are familiar with this from a personal retirement income standpoint. There's a slight twist with business owners in that the LLC member or the S-Corp owner can allocate what type of income, again, W-2 or K-1 income, they want to use from an accounting standpoint to pay that premium into the life insurance policy. The policy is personally owned and it is after-tax income, but there may be some employment tax savings, again, if it is a K-1 distribution that they're using to pay the premiums into that policy. After tax from a federal income tax standpoint, gross tax deferred and the retirement income from that policy will be tax-free as long as we adhere to MEC limits, as you would imagine. There's no contribution limits. Think of it as a spectrum of efficiency and flexibility on one end, on the opposing ends of the spectrum. The efficient way is to design it with the lowest possible death benefit to absorb a specified contribution and to make that contribution each and every year. As we move toward that flexibility end of the spectrum, because businesses have varying cash flow, I mean, we obviously know that especially in today's environment, the more flexibility you want to have from lower to higher contribution amounts, we have to build in higher face amounts. So we lose some of that efficiency as we move towards that flexibility end of the spectrum. Ancillary benefit here is there is a death benefit that's paid to the survivors of that business owner when he or she passes away. So again, leveraging life insurance and specifically leveraging products designed for this type of solution to supplement retirement income needs that business owners are facing. So let's talk a little bit about some of the benefits and considerations in that plan. This highlights a couple of them. One, from a benefit standpoint, it allows business owners, these S-Corp owners and LLC members to save more. It allows them to be diversified in that it's an after-tax bucket of money that they can draw on tax-free if they maybe don't have any medical expenses or prior to moving to a low-income tax state, as an example. It also allows them that flexibility to allocate the premiums as W-2 income, or they're going to have those employment taxes, or K-1 income, where they don't have those employment taxes. From a consideration standpoint, it is taxable income, as we've talked about. And if we have more than one owner, we need to make sure, and they want to use those K-1 distributions, we have to make sure that those are used in proportion to the ownership of the business. So if Michelle and I own a business 50-50, and I want to put $10,000 as allocated via a K-1 distribution into my policy, she would also have to take a $10,000 K-1 distribution. So just want to make sure that that's something that's in the back of your mind if you're working with those businesses that have more than one owner, but are taxed as a flow-through. There are other considerations, there are other benefits. These are just a couple that I wanted to highlight for you. So with that, I'll kick it back over to Michelle to talk a little bit about a few unique advantages in designing these types of plans, something we call the power of three.
Thanks, Dan. And you know, Dan did a great job of talking about the focus of the S-Corp owner plan or the LLC member plan is to, you know, save for retirement on the most tax-effective manner. They're really concerned with obviously paying the least amount of taxes. And we all know life insurance is usually the most tax-effective tool that anybody would have. The tax deferral on the cash value is very strong. And then the fact that you can take the money out on a tax-free basis is really the key thing that sells life insurance. And that is true as long as everything happens the way it's supposed to. And Principal really wants to make sure that this process is as streamlined and simple for the business owner and any executives that are going into this plan. And so we put together the power of three, which really takes into account the three different components of using life insurance in a retirement setting. The first is underwriting. We'll talk a little bit about accelerated underwriting and the expanded fluidless, but we want to make it easy for business owners to get this coverage in place. They're too busy to mess with a lot of the requirements and exams and that kind of a thing. The product has to be easy to understand, which is step number two. It has to be fairly transparent and easy for the business owner to see what's going on there. And then finally, the administration, making sure that the money comes out of the policy the way the business owner wants it to and the way it's illustrated. So the power of three takes all of those into consideration. So again, the first step is really underwriting, and Principal has some fluidless options that are very valuable in today's environment. So we've had accelerated underwriting for 5-6 years. We were the first to come to market with it, and it is still available up to $1 million for qualifying individuals. It's any product, anybody from standard to super preferred can qualify. The key is that they have no major medical conditions, and their build falls within a certain chart, and they go through the process and they are qualified through our underwriting process. So again, accelerated underwriting up to $1 million. With the current situation that we have and the fact that clients do not want to do an exam for any face amount, we have expanded the guidelines upon which individuals can get fluidless coverage. So if you have somebody who's up to 40, they could potentially get up to $2.5 million on a fluidless basis. Or if they're 41 to 60, they could potentially get up to $2 million. A lot of the requirements and things we're looking for are very similar. We don't want them to have any major health issues, medical issues. They need to fall within the build chart. And then the key with the expanded guidelines is that they have had a physical in the last 24 months. That includes blood workup, and that we can access that information. So we'll grab that information and use everything that we can access to hopefully get a policy issued, again, up to that $2 million or $2.5 million. Those amounts are pretty expanded, especially when you're looking at doing a retirement type of life insurance policy, because as Dan had mentioned, you're max funding these. You really want the death benefit to be as minimal as possible given your premiums. So those expanded guidelines will certainly give you enough room for the clients to put in the type of premium that they're looking for. The second piece is the life insurance itself, and Principal has a number of choices. We have index products, we have variable life policies, and they're all excellent and very competitive. All of our products are very transparent, which means it's easy to see how the values are derived. You can take a look at the different reports and see the expenses and see where the money is being allocated and how it grows. There are no multipliers or confusing bonuses that cause concern or make it hard to figure out what's going on within those policies. And all of them have a very low cost structure. Our goal is to charge as little as possible in these policies so that there is more premium going to work inside the cash value for the client. So you'll find our policies are very streamlined, very transparent, and clients really appreciate that. But finally, the most important piece, which is often overlooked, is the administration of those policies. How is the client going to get the money out? Is it easy? Is it going to be tax-free the way it was illustrated and sold? Principal really automates that entire process and makes it easy for the client. So basically, they ask one time for the distributions, they fill out a form, and we'll just keep sending that to them until they tell us to stop or the policy can't support it any longer. We make sure that the policy operates as efficiently as possible. So when they request those distributions, we're going to take that from an increasing death benefit, which is often the design in these plans, to a level death benefit to maximize those distributions. And we do that automatically. It's part of the process. We will take surrenders to basis because those are received tax-free, as we all know, and then we'll switch to loans to the penny to make sure that that client doesn't take any distributions above basis because those would be taxable. And then we will make sure that the policy does end properly, that once they've taken all they can out of the policy, our overloan protection automatically kicks in to protect that policy from lapsing, because if it does lapse, obviously there could be a significant tax impact. This is all illustrated on the next page. So this is an S-Corp owner that had $1 million of pre-tax income to allocate, and they decided to use K-1 income versus their W-2 income because they leverage the fact that they don't have to pay those payroll taxes. So if they had used the regular income, they would have had about $72,000 after tax, but because they use their K-1 income, they have about $76,000 to put in the annual premium on this policy. So they fund it for the 15 years that they planned on it, and then they come in year 16 and say, I want to start taking money out of my policy. And they could say, I want to take $199,000 out every year for 10 years paid monthly. Or they could say, I want to take the maximum I can get out of this policy and have Principal recalculate that annually to make sure that they, in fact, are getting the maximum that they can. They don't take too little, they don't take too much, and that they will have a full 10 years of distributions. So this gives you an idea of what that would look like. When they fill that form out, one of the items on that form is that we will decrease that death benefit or make it a level death benefit versus an increasing. And in some products, that can make as much as a 15% difference in the amount of distributions that you're able to make or take. So having us do that on an automatic basis is key because a lot of carriers would require a separate transaction to complete that. So then they would start receiving their distributions, and usually around year 7 or 8, they have taken all of their basis out of the contract, which means in this situation, they've taken out the $1.14 million that they put into it. If you don't switch over to loans to the penny, anything that they would take above that in a distribution basis would be taxable. And that can be a significant amount because many times they won't realize that until the end of the year when they get their their 1099 from principal. So having us switch from distributions to loans to the penny is critical, and we do that for them. And in this situation, we would put the overloan protection into play as soon as they have taken all they can out of the policy. And you can see very clearly when this happens in year 26. They go from a over $1 million death benefit in year 25 to a basically $47,000 death benefit in year 26. And really that $47,000 is the amount that the remaining cash value would be able to support based on our calculations. Once we put that into that reduced paid up contract, which again happens automatically, the client does not have to opt in. They don't have to tell us to do it. We will automatically put them into this reduced paid up contract so the policy cannot lapse. And then the policy is guaranteed to pay a death benefit when they do pass away. So the key there is that they would not have the policy lapse. The challenge is if that automatic switch didn't happen to overloan, they could potentially be taxed on all the loans that are outstanding on that policy if it were to lapse. That's $854,000 worth of loans that they would be taxed on. So having that occur automatically is key. You are also able to take a look at the policy and actually reduce the face amount when you start the distributions. So in the previous illustration, we just started distributions. We didn't actually change the death benefit at the time we started to do that. But if you did reduce it, you would be able to get an additional $4,000 to $5,000 a year out of the policy by just adjusting that death benefit down a little bit in order to maximize the distributions. One thing to note is that isn't an automatic thing that happens, but it is something that you clearly can help the client do at the time they start those distributions. So hopefully we've given you some options for your S owners and some ideas there. Dan, do you want to talk a little bit about C Corp owners and what their options might look like?
Yeah, absolutely. And we'll start with just like we did with S corps and flow through business. We'll talk a little bit about the basics from a taxation standpoint. So a C corp, it's pretty simple actually if you look at it in comparison to the flow through types of businesses. There's a corporate tax rate where the company pays a tax, and then there are also, from an owner standpoint, there's personal taxes that would be due, just as if you were another employee. From a corporate tax rate, we're looking at a flat 21% federally, plus any applicable state taxes as well. From a personal tax standpoint, we're looking at a top marginal rate of 37%. Again, that scales up from a much lower number as well. So there's two levels of taxation for C Corps. Now that can be a challenge because of double taxation. However, it also allows us that arbitrage between those two rates. It allows us to implement certain types of plans that are beneficial to the owner and also to the business itself. So a couple of options we'll talk about here today. The first one will be the executive bonus plan. The second is their simplified deferred compensation plan. We see this a lot with C Corp owners. And then lastly, we'll round up with the loan split dollar plan, which is something that we're seeing a lot of here in today's environment. I'll talk a little bit about as to why we're seeing that, especially in today's world. So with these types of options, the first is the bonus option. And really the benefit here, if you're simplifying it, just like Michelle talked about with that last option, is we're leveraging life insurance and the ownership of the plan and the ownership of the company being with the owner to determine how that plan is going to take place. So the policy cash values grow tax deferred, and the owner takes dollars out of a personally owned policy tax free. The nice thing here is we've talked about how there's double taxation, so there's tax being paid at the personal level and the company level. Who is the owner of the company? That is the owner of the company. So if I'm the owner of a company, I can actually gross up for taxes so that my personal tax that's due on a premium into the plan is covered by the company as well. So it's an opportunity to leverage corporate dollars to pay the tax for the individual, in this case, the owner of that plan. And so let's look at how that would look. A similar plan to what you saw in the previous example. There's a bonus given of $79,000, which is in that left blue box. That is deductible to the business, so that is the total amount that's going into the business, and then there's a gross up paid on top of that. So roughly, we'll call it $20,000, depending on which marginal rate that owner would be in. That full amount is going to be tax deductible to the business. So you see the after-tax cost of just the $79,000 portion is $62,000 based on that 21% flat tax rate. Those policy cash values grow tax deferred, and the owner is able to take about $210,000 out of their policy each year for 10 years. Again, however they do that, whether it be quarterly, semi-annually, or monthly. In this example, to maximize that distribution, we did reduce that death benefit, and that is an option for owners, but it's not mandatory. Just allows them to maximize the living benefits of that plan versus some of the death benefits that we would see if that is of importance to them. Now we'll move on to the DC CERP plan, and this is deferred compensation CERP. This is for-profit organizations. So essentially, if I'm the owner of a company, I'm promising to pay myself X dollars in the future, and that is a liability that I carry on the company balance sheet. And I found that CFOs don't like having unfinanced or liabilities that can grow without potentially having an asset to offset those liabilities. So while we're not formally funding that promise to pay in the future, whether it be in this case an owner or a key employee, we are going to set funds aside equivalent or approximately equivalent to the amount that we're promising to pay that owner in the future. The reason behind the benefit here is what I talked about with the margin and the arbitrage between the personal tax rate and the corporate tax rate. So if you recall, the top marginal rate for an individual is 37%, whereas the top marginal or the flat rate for businesses is 21%. So if I have $100,000 of company profits and I bonus those to myself as an employee, I'm paying 37%. So I have a net $63,000 that's going to be growing. Whereas if I keep it inside the business, I only have that 21% tax rate, and so I've got $79,000 that's going to be growing. So this is especially important if I'm going to be in a lower tax rate when I retire than I'm in today. So it allows you to leverage that arbitrage between the corporate rate and the personal income tax rate to benefit the owner in this situation. So let's look a little bit how that works. So in this plan, the employer contribution, and you see columns 1 through 4, is the liability. So there's a $79,000 promise to pay myself in the future. Now we can tie that growth of the $79,000 to a number of things. In this case, because I'm the owner of the company, I'm going to dictate that liability grows at 4%, which you see in column number 3. So at the end of year 1, if I was vested in the plan and it was paid out, I'd be owed $82,000, just $79,000 times 1.04. Each year, there's a discretionary contribution into that hypothetical account of $79,000. So it's a pretty great deal for me as the owner and employee in this situation as well. Now, I talked about that liability that that company is going to be having and how we like to offset those liabilities with a corporately owned asset. In this case, what's a great way to fund or to finance a plan based on the tax deferred growth that we see? We see that with life insurance. So columns 5 through 8 are going to signify a life insurance policy that's funded at the exact same amount as the employer contribution. You see that policy cash value and the net accumulated value grows tax deferred, and then the company is going to be accessing those policy cash values to pay that benefit to the employee, in this case the owner, in the future. Just a reminder, I hear a little bit of background noise. Just a reminder to mute your line if you wouldn't mind. I believe I heard someone that was not muted. Perfect. Thank you. So in this case, the company is going to be accessing about $150,000 that you see in column number 5, and pair that with the deduction that they're receiving and bonusing those dollars to the owner to equal the liability or that payment to the key employee to the owner of the company in this specific case. So the owner is getting $195,000, which is taxable income, each year for a 10-year period in retirement. The nice thing from a company standpoint is if I were to sell that company as an example, the liability is offset with an asset, and there's also cost recovery baked in. So after I pay myself, the owner or the key employee, after I pay that individual that promised retirement benefit, I still have a net surrender value there in year number 26 of about $900,000. There's also a death benefit that serves as cost recovery from an employer standpoint as well. So it's a great plan, especially if I'm the owner of the company, to leverage that differential between corporate rate and personal rate, as well as have some flexibility in the plan and potentially using my lower retirement income tax rate than a rate that I'm currently in. So a couple of key points from a DC SERP. Policy can serve as a key person plan. Lower income tax rates is really the big takeaway. And the other nice thing, we used to have pushback for these corporate-owned policies in that there was that alternative minimum tax that was due, which was actually eliminated as part of the Tax Cuts and Jobs Act of 2017. So we don't have to deal with that anymore. The other benefits there we see is more money in retirement income for the owner, but it is taxable income to that owner in retirement. So again, there are certain things that we want to make sure that we balance, and we've actually seen owners that have done both this plan and the bonus plan for themselves as well. So again, pros and cons of each of these types of plans. We want to make sure that we customize the benefit based on the goals of the company and based on the goals of the owner himself or herself as well. So the next thing, we talked a little bit about how that policy would be corporately owned. That death benefit that I talked about could be endorsed as part of an endorsement split dollar plan to the owner. So that's where a policy is corporately owned and the death benefit is split between the company and the employee or the owner in this case. The second type of split dollar plan that we can look at is what's called a loan split dollar plan. And this is instead of a corporately owned policy, this is going to be a personally owned policy. So that's the major difference. Now in loan split dollar, here are the benefits. The employee or the owner is going to be the one that owns the policy. The tax-free death benefit is going to be split, as we've talked about, between the employee and the company. So in this type of plan, the company is going to be paying the premium as a loan to that owner. So if I'm the owner and the company is loaning me, let's say, $100,000 per year, I'm taxed on the loan interest, not the loan amount or the premium amount. Now, I have certain ways that I can exit out of that loan. I can either access policy cash values and repay the loan to the company. I can have the death benefit repay the loan to the company. Or if I'm the owner of the company, I can forgive that loan. And that's an option that provides the company with flexibility for those three recovery pieces. Now, the benefit here, and this is really where the plan tends to sing, is that interest rate that I'm paying as the owner of the company. The interest rate that I'm paying personally for that loaned premium is incredibly low today based on the low interest rate environment. So that's going to be the first key piece. The second piece is all of the cash value that grows tax deferred. I can use that to A, repay the loan, and B, anything above and beyond what's been paid into that policy, I can access tax-free. So it's a way to take some chips off the table, if you will, from an ownership standpoint. Now, the policy itself has a death benefit, as we've talked about. Whatever that amount of the loan, we're going to collaterally assign that portion of the death benefit as well as that portion of the cash value back to the company in those situations. So you've got a safeguard, if you will, from a company standpoint. So that's another key piece about this type of plan. Once that loan is repaid or if the loan is forgiven, we terminate that collateral assignment and the employee, in this case, the owner of the business, owns the policy free and clear. Now, both the DC SERP plan that we just talked about as well as loan split dollar are only applicable to C Corp owners. They're not going to be appropriate for those flow-through owners, and that's because of the flow-through status of the business. Anything that's held at the company level still flows through to them from a personal standpoint. I've talked a little bit about these exit strategies. Just a refresher, there's a loan repayment, which can be paid out of the policy cash values, or there's a loan forgiveness aspect, which the company can forgive that loan, which would terminate the loan. Here's a quick snapshot. I know we're running up against our time here. Here's a quick snapshot from an illustrative standpoint on how that plan would look. So you'll see here in the blue column on the left, there is a about $600,000. There was, $900,000 that was paid by the employer as a loan into the policy that's personally owned. Now the employee is going to be, looks like they're forgiven in this specific situation. Actually, no, they're taking $300,000 out of the policy cash values and repaying that loan, which is that negative 336 at the bottom of the left-hand side of the illustration that you're looking at. After the employee repays that loan, the policy is theirs free and clear. So the big takeaway here is in year number 21, they have $1.3 million that they have access to tax-free, as well as a $2.3 million death benefit. We do administer this type of plan free and clear. And with that, I'll flip it back over to Michelle.
Great, thanks. And as we discussed some of these different plan types, it's probably easy to see why administration can be very important. There are certain things that need to be tracked and accounted for. And Principal does provide plan level administration on all of the plans that we talked about on a complimentary basis. So things like having an administrator that the business owner and the advisor can call with questions on how does the plan operate, that kind of a thing. Getting annual reports that include a summary of where they're at from a plan perspective, but also includes any tax reporting information that client might need. Things like the loan interest that needs to be includable in the employee's income or the employer's income in the loan split dollar scenario that Dan just talked about. Or if it's an economic benefit split dollar, then they need, or the endorsement split dollar rather, they need to have that economic benefit calculated and sent to them each year. So those are the kinds of details that Principal will take care of and send it to the employer, and just to help them make sure that their plan does stay on track. So they're buying a benefit plan right now. They're not really buying a life insurance policy. The plan is a solution to their need, and the life insurance just happens to be the funding asset. So getting an annual statement each year that says, Dan Hardy Inc. CERT plan will remind them of what this is really designed to do. Whereas if they just got a life insurance statement, it really wouldn't tie everything together. So it helps with consistency. It really helps that business owner make sure the plan stays on track. And we provide a lot of support. They can access everything online. And again, all of the tax information and other things that they need to know are reported to them annually. So it is a great service that we provide. And again, we do that on a complimentary basis just to make sure that the plans do stay in track. So at this point, I wanted to see if you have any questions. You can press *6 on your phone, and Dan and I will be glad to address any questions that you might have. If you have any, just jump in. But hopefully, we've shared some ideas that will help you as you talk with your business owner clients and talk to them about some retirement planning strategies. I would encourage you to think of 1 or 2 business owners that you might want to give a call to, whether that's now or as soon as the recovery starts. Just making sure that you stay in front of them with these ideas. They are thinking about doing this planning, but the reality is they don't know how. They don't know how to monetize their business in retirement, and they need your help. And that's what Dan and I are here to help you as you kind of talk with those business owners. You find some people who might be interested. We would be more than happy to visit with you about the different options that might be available, what kind of strategy is going to work best, and help you put together a solution. So if there are no questions, we look forward to working with you, and please reach out to Dan or I. Have a great day, everyone.